If your credit score isn't good, you won't get the house, car, insurance, and life that you want. Your score determines if banks will lend you money, what interest rate, and even how much you'll pay for insurance. It can also affect your ability to rent a home or get certain jobs. So, your credit score matters, and it's important to improve it as soon as you can. In this video, I'll explain what you need to know about your credit score and how to improve it in 2024. Let's get started. First, what exactly is a credit score? There are different types of credit scores out there, but the most commonly used one is the FICO score. It's like the king of credit scores in the United States. Other types of credit scores might have different names or be tailored for specific purposes, like auto loans or mortgages, but when people talk about credit scores in general, they're usually referring to the FICO score. Your FICO credit score is like a financial report card created by a company called Fair Isaac Corporation, FICO. Lenders use it to decide if you're good at handling money. FICO scores go from 300 to 850. The higher your score, the better. Think of it as a grade that tells lenders how responsible you are with borrowed money. The higher your score, the more trustworthy you seem, which can lead to better loan offers and lower interest rates. Your FICO score is like a grade for your financial habits. Different factors influence it. Your payment history has the biggest impact. It's like showing up on time for class every day. This counts for about 35% of your score. The next big thing is how much you owe compared to your credit limits. Think of it like how much you've already spent on your credit card. This makes up around 30% of your score. How long you've been using credit is also important. This counts for roughly 15% of your score. Opening lots of new credit accounts can hurt your score. It's like trying to join too many clubs at once. This makes up about 10% of your score. Finally, the types of credit you use matter too. It's good to have a mix, like using both credit cards and loans responsibly. This makes up around 10% of your score. So, your FICO score is a mix of all these factors. Keeping them in check can help you maintain a good score and open up more financial opportunities. Now let's talk in more detail about these factors and what you can do to improve them. Payment history. Your payment history plays a big role in your credit score. It's all about whether you pay your bills and credit cards on time. Late payments can drag your score down, so it's super important to stay on schedule. Make sure you pay your credit cards on time, every time. Many credit card companies offer auto pay, a handy feature that automatically pays your balances for you. It's a stress-free way to keep your score in good shape. If your credit card company doesn't offer auto pay, this is a red flag, and you should definitely switch to one that does. Missing payments can really hurt your score and cause you to miss out on perks like 0% interest offers. To stay on track, mark your billing cycle's last date each month and aim to clear your cards before then. Your payment history carries a lot of weight in determining your credit score, so it's important to keep it clean. Credit utilization. This is how much of your available credit you're using. It's like portion control for your finances. Using too much can signal to lenders that you might be overextended. Experts recommend keeping your credit utilization below 30%. For example, if you have a $100 credit limit, try to spend less than $30 on it. This keeps your usage in check and your score healthy. But here's a tip. Aiming for even lower, say 10%, can impress lenders even more. It shows them you're responsible with your credit. So keep an eye on how much credit you're using. It's a simple way to maintain a good credit score. Length of credit history. Lenders prefer to see a solid history of responsible borrowing. So it's wise to hang on to old accounts even if you're not actively using them. If you're new to credit, getting your first credit card is a great start. But if you're having trouble getting approved, don't worry. There's another option called a secured credit card, like the ones offered by Discover. These are easier to get because you have to put down a deposit. Let's say you deposit $100. In return, you'll get a credit line of $100. Secured cards are perfect for beginners without any credit history. They're a big step in building your credit. As you gain more credit cards over time, your credit score will gradually rise. New credit inquiry. Whenever you apply for credit, whether it's a new credit card or a loan, it triggers something called a hard inquiry on your credit report. Having too many of these inquiries in a short time can set off alarms for lenders. That's why it's important to space out your credit applications. Applying for credit too frequently, especially all at once, can lower your score. Lenders might get concerned if they see you applying for lots of credit simultaneously. They might think you're facing financial difficulties and trying to borrow a bunch of money all at once. So, as a rule of thumb, hold off on applying for new credit if you want to maintain a high score in the short term. But keep in mind that while new credit inquiries might cause a temporary drop, they can actually benefit your score in the long run. Just be mindful of the timing, especially if you have major plans like buying a house. Credit mix. This simply refers to the different types of credit accounts you have, like credit cards, loans, and mortgages. Having a mix of these can actually boost your score. Once you've started building your credit history and consistently paying your bills on time, you want to get more than one credit card. Why? Well, having multiple cards increases your overall credit limit. For example, if you have one card with a $500 limit and get another with a $1,000 limit, your total limit becomes $1,500. It's like leveling up your credit potential. Having multiple cards can also strengthen your credit history. Lenders like to see that you can handle multiple accounts responsibly and pay them off on time. Credit report accuracy. This one's not part of the FECO score, but it's super important. Mistakes in credit reports are more common than you might think. They can include missing accounts, duplicate entries, or reports incorrectly stating that closed accounts were shut down by the lender instead of you. If an account is reported multiple times, it might look like you owe more than you actually do, which can harm your credit score. To spot errors, you can use tools like Annual Credit Report, which is completely free and can be used multiple times a year. When you spot an error, reach out to both the credit bureau and the entity providing the information. According to the Fair Credit Reporting Act, they're obligated to fix legitimate errors. You can find online guides to help you through this process if you need to. Fixing errors on your credit reports can have a huge positive impact on your credit score, so it's definitely worth the effort to get things straightened out. I hope that you found this video helpful. If so, I'd really appreciate it if you like and subscribe for more like this.